Welcome back to Ask the Lawyer with me, Mike Connors. Right now with me is FrankMeila from Quantic Bank. And a lot of times when we do seminars or clients have questions about reverse mortgages, I always say talk to FrankMeila, and here he is to answer our questions today. Frank, what's a reverse mortgage and how does it work?
A reverse mortgage, Mike, is a government-insured loan program that came out back in the early 80s. The public just started to hear about it, I believe, more like in the last 10 years. And the way the program works is the owners of the property have to be age 62 or older. It could be on a 1 to 4 family house, a condominium, no co-ops. And the loan amount that the borrowers are qualified for is determined by the age, the youngest age of the borrowers, the present interest rate environment, and the value of the home. So the way the loan amount is determined is given to the borrowers during a counseling call that is done first, and then the loan application is done through a local bank. The only difference between a reverse mortgage and a traditional mortgage for your listeners is that a reverse mortgage does not have a required monthly payment. There is interest that's being charged on the amount that the homeowners borrow, but they do not have to mail in a payment every 30 days. They can mail in payments because there's no prepayment penalties, but most people look at a reverse mortgage program to free up cash flow and to pay off whatever existing loans are on the property, so they do not have to make a payment on a monthly basis if they choose not to.
Okay, now reverse mortgages have been around a long time, but it seems that something changes every year or so. Are there any new changes to the program?
Great question, Mike. The government just did make changes this past October. Prior to this change, there were some slight changes that took place 3 years ago, where the government first started to implement to banks that we needed to check a homeowner's credit report and we needed to verify their income. Now, the credit and income requirements from the previous changes aren't as strict as a forward mortgage. You don't want to purchase, but we do have to look at their credit and income. What changed this past October was the amount that homeowners can take out of the property. Basically, the loan amount was decreased. This was the government's way of keeping the product viable over the next 20, 30 years. If you look back 10 years ago, the government program allowed a homeowner to take out up to 85% of the present market value. With the present changes that took place in October, homeowners now can take out anywhere from 40 to 70%. So what the government did was pulled back the amount that a borrower can borrow to maintain more equity in the property. The second change that they made was they changed some of the upfront fees. Prior to the October changes, a homeowner could face 2 different types of closing costs, depending upon how much they were looking to take from the property. Now they've combined those 2 amounts and made it one closing cost option. It did increase some of the closing costs on the upfront. But the third change, which I believe is the best change, is that they lowered the ongoing FHA insurance costs. So now the loan is cheaper over time. So those are basically the changes that just took place in October. So if any of your listeners have been thinking about talking to a professional regarding a reverse mortgage, now is the time before they make changes again.
Here's one question I get a lot, and I don't know exactly where this fear comes from, but a lot of people fear that if they take out a reverse mortgage, the equity in their house is lost and their children will receive nothing by way of inheritance. Is that true?
No. I hear that on a daily basis as well. I find today it's a little bit, or homeowners are doing their homework. There's more information now on the internet. Shows like yours, shows around the country do explain the program a little bit to homeowners. But what we're here to do is to educate homeowners on exactly what you just said. The home is always the borrowers, the homeowners. The house stays in their name. The deed stays the way the deed is at the present time. And like I just mentioned, by the government lowering the amount that a homeowner can take out of the reverse mortgage, it will keep that equity at a larger percentage. There have been incidences, like I said earlier, when people were able to take out 85%, that people might have gone through the money and they may face no equity in the property. But I just want your listeners to keep in mind that it's what you do with the money that's the most important part of this program. Because if you take out a reverse mortgage, speak with your financial advisor, speak with your attorney, and go over the program features with a bank like ours, we will let the homeowners, their children know what the future holds for them, more or less on the sense of how much equity they'll maintain in the property. And hopefully what you just explained will never happen to homeowners anymore. especially because the government just lowered the amount that they can take.
And in a lot of cases, if you've been living, especially in Brooklyn and Queens, but all parts of the city, real estate has been going up so much that a lot of times the equity increases even with the loan.
I agree. And there was just an article recently in the New York metropolitan area that did state that. And that was another thing that I was going to mention to your listeners, that home values in Brooklyn, the boroughs, the entire New York tri-state area is back to some of the highs that we saw before the mortgage and the financial crisis back in 2008. So if any of your listeners are looking into this program, like I said, it's based on the home value and the age of the borrowers. So with home values being as high as they are right now, it may entitle the homeowner to get a larger line of credit. It may work to their advantage.
Now, we know real estate values are very high right now. If the value of my house goes down and I have a reverse mortgage, can they call in the loan?
No. The loan is with the homeowners as long as they're with us. What I mean by that is at any time the homeowners can sell their home, but if it's a husband and a wife, it's a joint life product. So the mortgage does not have to be paid, or the mortgage will not be called by the lender until all of the borrowers are either no longer with us or the home is being sold. And the home is always in the name of the borrower. So there's nothing that would have the loan be called unless the only contractual obligation that needs to be satisfied is paying your real estate taxes, your local real estate taxes, and maintain homeowners insurance on the property. So if any of your listeners or if any borrowers were to fall behind on their insurance or their real estate taxes, then the lender would notify them, but there's no way that they can lose their house.
All right. Now, another question I get fairly often. If I put my house into a trust, can I get a reverse mortgage?
I receive that call a lot, Mike. And yes, our bank does lending in trusts. We get a lot of calls from attorneys and financial advisors, as well as homeowners that did planning with an attorney. They either did a life estate or they might have done one of the trusts that the attorney recommended. And our bank is trust friendly. I actually run the trust lending division for Quantic Bank. And we will look over the trust. We will let the borrowers know if they qualify. If there's any changes that are needed, we'll communicate directly with the borrower as well as their attorney.
Now, if somebody wants to meet with you, do they have to pay for that meeting?
No. Quantic Bank is a federal chartered bank. I'm one of the vice presidents, and I will sit down with your homeowners in their home, in one of their advisors' offices, or one of our local branches, or we can communicate through the phone, but there's never a charge for any consultations.
And how does somebody learn more about Quantic Bank, your services?
Simply call me at 888-943-2646 or go to the internet and go to www.quanticbank.com/FMeila. And once again, they can call 888-943-2646 to get me directly.
Now, I just want to add one further point. You know, a lot of times people, let's say, as they're getting older and they're strapped for cash. And of course, we have a lot of people in New York City area that real estate rich, cash poor. Now, if they get a regular home equity line of credit or mortgage, if they don't make the payments, they could lose their house. With reverse mortgage, you don't have to make the payments until either you sell the house or after you're gone. You mentioned the fact you got to pay the real estate taxes, but you got to pay the real estate taxes no matter what. And if you don't pay the real estate taxes, you could lose your house. So at least with a reverse mortgage, you may have some funds to help pay those real estate taxes in the long run. And number two, you better pay house insurance anyway. So that's really not a negative, because God forbid you don't have house insurance. I mean, you could lose your house. You could have a fire. And I know occasionally, I'm very surprised at this once in a while. Occasionally somebody comes in, they didn't have a mortgage on the property and they don't have house fire insurance on it. So please, you know, if you have a house, get insurance. But that's something you have to pay anyway. But if you take out a reverse mortgage, you take out a regular mortgage, you can't make the mortgage payments, you lose your house. You take out a reverse mortgage, you're not going to lose the house. And then the house eventually pays for the mortgage after you're gone.
Correct, Mike. And I have these conversations on a daily basis with a lot of the borrowers that do contact our bank. The property always is in the borrower's name, like we've previously discussed. And there is a similarity, like you just described. People do have the obligation to pay their real estate taxes and maintain their homeowner's insurance. But the flexibility that this program gives local homeowners, and I can tell from experience, is the cash flow that you mentioned earlier. If someone is tight right now, or if someone lost a spouse, or if someone, for some reason, is receiving less income going into the new year, sometimes the reverse mortgage just frees up that cash flow. Like you said, you still maintain your taxes and your insurance, but you do get that flexibility. So if you don't make a payment, and if you choose not to make a payment on the reverse mortgage, you will never go into default.
All right, one last time, Frank, how do they contact you?
They call me directly, Mike, at 888-943-2646, or visit the internet at www.quanticbank.com/FMeila.
Frank, thank you for what you're doing for senior citizens.
Thank you, Mike. Have a great day.